Hi there everybody and welcome back to another stock analysis video. Today I would actually like to visit once again Berkshire Hathaway out of the suggestion of one of my commenters, Mauricio Bessarelli. Says, great video man, was wondering if you could analyze Berkshire Hathaway B. They seem to beat the S&P 500 every single year. Now for all those of you who may know, I actually did Berkshire Hathaway a couple weeks ago, and unfortunately I did not do B, I did A, mainly because they're essentially the same stock. They have the same fundamentals and everything. It's just that B is significantly way more, I guess you could say, affordable than that of A by several $100,000. So let's actually analyze this once again. It's been a while since I've analyzed it. Let's do this once again, seeing now that we actually have the projected shares outstanding in the future. Last time we did this, we didn't have that. And let's see what we can come up now with Berkshire Hathaway B. So with that said, let's get started with this analysis. We are going to come right into the calculator, guys. Berkshire Hathaway does not pay out a dividend. Ticker symbol of BRK.B. They do have, of course, as I said, A, which is in the hundreds of thousands of dollars, the most expensive stock in the stock market. However, Berkshire Hathaway B, same exact company, same exact fundamentals, same exact everything, except the share price is a lot more affordable. Market cap of $670.6 billion, PE of 0.01. The reason why this PE is this low is not necessarily because it's this low, it's just solely because of the fact that it is still based off of the fundamentals of Berkshire Hathaway A, and seeing that the current share price is 304, it pretty much is showing that this share price should be a lot higher. However, we're going to analyze by how much, and I had to do a little bit of finagling with the numbers to actually come up with a reasonable answer, because things get a little bit complicated. So just stick around and I will show all of you guys what I did to get the numbers that I get when it comes to the assumptions part of the video. Now, they do not pay a dividend, which means that their 5-year average free cash flow of $26.5 billion is going into themselves to reinvest in the company, grow the company, to pay down their debt, and buy back shares. Looking now at the fundamentals, guys, starting off with the net income 5 years ago of $45 billion to 1 year ago of $89.8 billion. That is a 100% increase. And as you can see right here, fairly interesting, mainly because of the fact that we see a huge outlier here in the 4 years ago, where they went down from 45 billion 5 years ago to 4 billion the following year, and then they shot up to 81 billion 3 years ago, and then they went back down to 42.5 billion 2 years ago, and then 1 year ago they shot up to, as I said, $89.8 billion. Now, this one I could definitely understand because of the whole COVID situation. However, what I don't understand is this one from 4 years ago. I still don't know why this happened. I don't know if anybody commented this in my other video, but nonetheless, this is definitely an outlier. Even though this one is explainable, this one isn't, and I would definitely suggest to look into what happened here as to why they did so little income 4 years ago. Taking a look now at the free cash flow, the lifeblood of the company, guys, cash from operations less your capital expenditures. Fairly interesting. I was not expecting this when it came to Warren Buffett's stock. 5 years ago of $34 billion to 1 year ago of $26 billion. That is a decrease of 23% with a 5-year average free cash flow, as we saw, of $26.5 billion. Now, what's interesting here is that if you were to just take away this 5-year ago number, this is essentially an increasing stock, right? It will go from 22.8 to 26. However, because of this 5 years ago number, it is skewing the entire aggregate down, even the trend line as well. But remember what cash flow is. It is cash from operations less your capital expenditures. And if we can actually see right here, when it comes to the cash from operations, they have been steadily decreasing their cash from operations. Well, to be fair, 5 years ago, they did have $45.7 billion. And then after that, they kept it around like the $38 billion. Now, the same applies when it comes to the capital expenditures. And if this goes up, that's not necessarily a bad thing, mainly because of the fact that this is them putting the money back into the company, which is something that you want to see. So just because their cash flow is decreasing in this manner doesn't necessarily mean that they are losing cash from operations, but just so that reinvesting more into the company, which is exactly what you want to see. Now coming over here to the revenue 5 years ago of $240.7 billion to 1 year ago of, look at this guys, $276.1 billion. That is a huge increase of 14.73% and fairly steady as well. Obviously the outlier here, only a little bit of an outlier honestly, was 2 years ago, and you could attribute this to COVID, but nonetheless, this is very solid. Taking a look now at the total assets minus the total liabilities. If they were to liquidate all of their assets, would they be able to cover their liabilities, and how much money would they have left? So you can see right here, currently, they have, wow, they have more than $500 billion in average assets minus average liabilities at $516.8 billion. Oh dear Lord, that is amazing. And not only that, guys, this has been increasing within the past 5 years as well. Leave it to Warren Buffett, man. Leave it to Warren Buffett to just take this company into his own hands and just make it so incredibly powerful when it comes to debt and paying down their debts, to the point that they have so much money after paying off their liabilities that I don't even know why they have debt, right? It's incredible. Average total assets is around $838 billion. Average liabilities around $402 billion. And doing this difference, we get $436 billion. Now looking at the shares outstanding, and this is the main reason why Berkshire Hathaway, at least A, is the most expensive stock right now in the stock market at $456,000. And that is the fact that, well, Warren Buffett doesn't like to issue shares or even buy back shares. He's a believer that his investors should definitely be one for the long term. Since he likes to invest for the long term, he wants the people that he attracts to his stock to do the same. That's essentially why the stock is worth $456,000, right? And the way you do this is you essentially, well, you lower down this to the point where you have $516.9 billion in assets minus liabilities, and you don't issue shares at all. 5 years ago, guys, they had 1.6 billion shares to today of 1.5 billion shares. That is a decrease on the 5 year of 6.25%, but they have not increased or decreased within the past 5 years either. But they have not increased or decreased from the previous year to the current year. In fact, this number has remained roughly the same, and only 3 years ago is when they actually bought back to 1.5 billion shares. So as it stands, this is actually fairly good. They bought back their shares, and on top of that, they have remained the same as well. They will probably not be issuing shares anytime soon. And lastly, looking at the cash equivalents, they currently have $39 billion in cash and equivalents with an average cash of around $50.2 billion. So now that we got that, let's make some assumptions: low, median, high, and using 3 different factors: revenue growth, predicted share buyback, and the required rate of return. Guys, revenue growth, I like to use Seeking Alpha's growth tab, looking at the revenue growth year over year, and of course the revenue growth forward, and making a conservative assumption between those two numbers. For the predicted share buyback, we just saw the shares outstanding, so I'm going to be using that. And for the required rate of return, I like to keep it flat, 10% to match the S&P 500. So we need to talk about this stock here for a second, because I needed to change a couple numbers here. Now, as you guys saw, the share price is $304. However, those numbers that we just saw when it came to the fundamentals are based off of the entire company. And unfortunately, this stock has Class A and Class B. And as you can see, Class A is significantly way more expensive than Class B is. As I said, Class A is what, $456,000, where Class B is $304. So I needed to make some changes when it comes to some numbers, because, well, if I were to not take into account the changes that I did, and I'm going to get to those changes in just one second, this would be the current target share price for this company. However, this is the current target share price for A, not necessarily for B. So what I did was, in order to get these numbers that you see right now on the screen, is that I took the ratio between Berkshire Hathaway B to Berkshire Hathaway A. And doing this division, so all I did was I took 304 divided by $456,500, which is Berkshire Hathaway A, and I got this ratio of 0.07%. And then I multiplied that 0.07% by the target share price that we got with Berkshire Hathaway A, which in this case was $771,000. In doing so, we get the target share price for what this class of Berkshire Hathaway should be worth. And as you can see right here for the low assumption, taking into account a growth of 2%, and let's say a predicted share buyback of 0, because they do have this precedent, this would come out to be a target share price of $513.78. Media assumption, revenue growth of 5%, and a predicted share buyback of 0.25%, this comes out to be $572 on the dot. And for the high assumption, a revenue growth of 8%, and then a predicted share buyback of 0.5%, we get $635.31. Now let's adjust for debt. And the way we do this is we take the cash equivalents and we add the net debt. If they have more debt than cash, this number comes down. If they have more cash than debt, then this number comes up. So you can see it does come up all the way up to $525.20 for the low assumption. For the medium assumption, it is $583.44. And for the highest assumption, $646.78. Now let's add the margin of safety to this target share price, adjusting for debt, just in case that we don't want to overpay for something. Adding a margin of safety of 5, 10, and 15%, we get between $446.42 to $498.94, essentially $500. For the median assumption, we get $495.93 to $554.27, and for my highest assumption, $549.77 to $614.44. Guys, as it stands, the current share price is $304. So just based off of these assumptions, we can pretty much see that this is an absolute buy. And seeing that, again, this company is based off of Berkshire Hathaway, which, let's face it, it's Berkshire Hathaway, Warren Buffett and Charlie Munger, right? You could pretty much assume that they might actually continue guiding this company in the correct direction. Even though these guys are very, very old, I think Charlie Munger is, 98, and Warren is 94 or 93. The people that they choose to continue the company, I think will have the same values as they both do. So I think this company will head in the right direction within the next several years as well, even after they're long gone. But as I always say in every single video, guys, these numbers right here are based off of my assumptions and my assumptions alone. You guys may not agree with me, right? If you guys think that no, Berkshire Hathaway will probably, not grow at 2%, that they're going to grow at 1%, and that they're going to buy back shares at 1% for the lowest assumption, then doing this change, we could see how much these numbers change by. And that just goes to show that every investment is the present value of all future cash flow, and you guys should make your own assumption, because none of this is financial advice. You guys should make your own assumptions. That's why I have this calculator available for free. Anybody could have it. I have this one, I have the book value one, and a dividend tracking sheet. And all I'm asking for these 3 free things, guys, is help me grow my channel. We recently made it past 600 subscribers, which is amazing. Thank you all so much. I made a community post about it. Thank you all so much. I would love to get to 1,000 by the end of this year. That would make me so incredibly happy. Thank you all so much again. I'm giving out these 3 things, and also I have in the works a couple other calculators as well. So just be on the lookout for that. So all I'm asking for in return, guys, is just help me grow my channel. Thank you all so much for the 600 plus subscribers. All in all, Berkshire Hathaway, guys, I mean, Warren Buffett, right? A lot of people even consider this its own ETF, I guess you could say, like the S&P 500, just because they just have so many good things going for them. I mean, Warren Buffett, you really can't, the world's greatest investor, you really can't go against that man, right? You just can't. So anything he touches, will essentially be good. I was actually thinking about buying this company, mainly Berkshire Hathaway.B, to put into like a growth pie or like a growth section in my dividend portfolio, or even make another investing portfolio in general, because yeah, I'm really interested in making one, seeing that now these companies, these major corporations like Google, Berkshire Hathaway have fallen this much, and it might be a pretty good opportunity to buy them now, and seeing that they don't pay a dividend, if I were to sell them in the future, it wouldn't hurt me that much. That's just what I'm thinking about doing. At the end of the day, you guys make your own assumptions, and you put your money where you want to put them, because this is not financial advice. That pretty much does it for this video. Like if you like, comment, subscribe. As I said, you guys can follow me on my new tech sites at BitChute, Odyssey, and Rumble. I also have a Let's Play channel currently doing a co-op gameplay with my girlfriend playing Stardew Valley. So if you guys want to catch that, you guys can follow me there. Links are in the description as well. With that said, peace out, and be on the lookout for the next stock analysis video.